Okay, let's just jump right in. It is time to completely demystify the financial, tax, and operational realities of acquiring commercial kitchen equipment here in Canada. If you're planning a build-out, an expansion, or maybe a major upgrade, you already know the stakes are incredibly high. Seriously, the financial decisions you make before you even plug in a single refrigerator can literally make or break your bottom line.
So, while opening a restaurant is, of course, incredibly exciting, we need to immediately address a massive question right out of the gate. Should you lease or buy your kitchen? Honestly, it sounds like a simple preference, right? But we absolutely have to tackle this head-on to avoid the #1 killer of new operations, which is cash flow depletion. It's kind of this silent threat that takes down amazing food concepts every single year.
To protect your capital, here is our step-by-step playbook for this explainer. First, the cash flow trap. Second, what lenders actually finance. Third, leasing versus buying. Fourth, the hybrid strategy. And finally, Canadian financing options.
Starting right off with Section 1, the cash flow trap. We really need to understand why so many enthusiastic, super talented restaurateurs find themselves in immediate financial trouble, sometimes even when they literally have a packed dining room. Look, Canadian food service sales exceed $100 billion annually. It's a thriving, massive industry. But getting your piece of that pie, it requires a staggering initial investment. Equipment purchases are huge upfront expenses, and if you don't structure them right, they're going to instantly drain your working capital. You need that cash for payroll, for marketing, for food inventory. You simply can't afford to have it all locked up in stainless steel on day one. I mean, your cash disappears fast enough in this industry as it is.
Moving to Section 2, what lenders actually finance. Now, this clears up the absolute biggest roadblock operators face, which is totally misunderstanding what a bank will actually approve when you hand them a quote for a brand new kitchen.
You see, operators often try to finance their entire build-out as one giant equipment loan, but lenders, they draw a hard line here. They'll happily finance movable equipment, like your ovens, fryers, and prep tables, because those items actually have resale value. If things go sideways, the lender can just repossess and sell them. But they will almost always reject built-in leasehold improvements like plumbing, custom hoods, or flooring. Why? Because those are permanently attached to the building and just cannot be easily repossessed.
Which brings us to Section 3, leasing versus buying. This is the core financial showdown between paying cash out of pocket versus leasing your equipment. And you know, it's not just about the sticker price, it's really about how the government looks at your business.
Let's consider the tax side of ownership first. If you buy equipment outright, it's considered a capital expense. This means you're forced into the CRA's complex capital cost allowance, or CCA system. And, well, dealing with tax codes is always a joy, right? Basically, you don't get to write off your $20,000 purchase on this year's taxes. Instead, you only get a slow, declining tax write-off. For example, miscellaneous kitchen equipment falls into Class 8, meaning you can only deduct 20% a year on a declining balance. It is a painfully slow burn. But on the flip side, the CRA typically treats equipment lease payments as an operating expense, or OPEX. This is a total game changer. It allows you to deduct the entire monthly lease payment from your taxable income right away, in the exact year you pay it. You're perfectly matching your expenses with your current revenue. There's also a massive sales tax impact to consider here. If you buy outright, boom! You're hit with a huge upfront GST or HST bill on the full purchase price. But leasing? Leasing means you pay and claim input tax credits gradually on your smaller monthly payments. You aren't tying up thousands of dollars of your hard-earned cash in a massive lump sum tax bill on day one.
To really put this into perspective, consider a $15,000 oven scenario. If you buy it, your total cost over 5 years is $15 grand, but you've drained $15 grand in cash immediately. If you lease it, your upfront cash is maybe $600 for the first and last month. Sure, over 5 years, you are going to pay more, around $24,000, but look at that bottom line. Leasing keeps over $14,000 of vital liquidity in your bank account from the very start. For a restaurant, having that cash buffer is often the difference between surviving a slow winter or closing your doors for good.
Okay, Section 4, the hybrid strategy. Actually, scratch the idea that you have to choose just one path. Blending these options is essentially a cheat code used by the most profitable food service chains across Canada.
The first half of this strategy involves walking through your kitchen plan and identifying your passive iron. These are the durable, everyday workhorses that are absolutely essential to your operation, but they don't actively generate any direct revenue. We're talking about items like stainless steel prep tables, sinks, walk-in shelves,
standard gas ranges, and shelving. The crucial point here is that you should use your available cash to buy these items outright. A sink is going to last you 20 years, but it generates zero profit to offset a lease. Paying lease interest on a sink just eats into your margins. So buy the passive iron and own it.
But then we have the second category, revenue iron. This concept completely flips the script because these items aren't just tools, they are your high-margin profit engines.
Think of premium equipment like Taylor soft-serve machines, high-efficiency Henny Penny fryers, or fancy super automatic coffee systems. Check this out. A soft-serve machine might cost $800 a month to lease. But because of its incredible 80% margins, it generates $3,000 in pure profit. That means the machine literally pays its own lease bill in the first 3 days of the month. The rest of the month goes straight to your bottom line, and you didn't have to tie up 25 grand of your own capital to get it.
All right, our final section, Canadian financing options. We've talked strategy, we've talked theory. Now let's look at the actual menu of financing avenues currently available to you.
There is a remarkably rich ecosystem of funding out there. For robust, risk-shared capital, you can explore CSBFP government-backed loans, providing up to $500,000 for equipment. If you need a more comprehensive package, BDC equipment loans can actually cover up to 125% of the purchase price, letting you roll in shipping and installation costs, which is huge. Beyond traditional loans, you've got flexible lease-to-own programs, short-term rentals perfect for startups testing a new concept, or even certified used equipment to radically lower the total amount you need to finance. Basically, there's a specific structure designed for your exact profile. To bring this all together as you build your own kitchen, just follow these 3 practical steps. Step 1. Classify your entire list into movable equipment versus leaseholds so you know exactly what a bank will actually entertain. Step 2. Separate those movable items into passive iron that you buy with cash and revenue iron that you strategically lease. Step 3. Secure specific quotes based on this exact structure. Doing this ensures you align your expenses with your revenue and completely avoid draining your emergency funds. I'll leave you with this final, absolutely crucial thought. Getting the equipment is really only half the battle. If your high-margin revenue iron breaks on a busy Friday night and you don't have a service warranty, well, whose bottom line bleeds? An unserviced machine will cost you far more than any monthly lease payment ever could. So think about the complete life cycle of your kitchen. Are you just financing metal, or are you actually financing guaranteed uptime? Keep your cash flowing, protect your assets, and build your business on a rock-solid foundation.